Good morning. This is Drew Erickson back again talking about money, not math, because I believe most people love money without realizing how often it doesn't work the same way as math. Plus, I love our country, but I believe our government is terrible at managing money and should not control our financial future. So my goal is to provide value for you so that you can hopefully enhance your, future financial planning. All right. So today I appreciate or a shout out to my friend and colleague Ross Welty. For sending me this article titled How to Calculate Roth 401k Withholding from budgeting.thenest.com. The reason why he sent this to me was because we were discussing how often people that we work with don't realize that the amount that they contribute to their traditional 401k versus their Roth 401k, it doesn't change when it's being taken out of your account. But it does affect how much money you take home, or it can affect how much money you take home because of the tax differences. But the two things we find that many people don't, notice or realize without having a further discussion is that if you're contributing 5%, and there'll be an example included here, but if you're contributing 5% into your traditional 401k versus 5% into your Roth 401k, the same numerical, numbered amount will go into your account. So if you make $100,000 and you contribute 5% to your traditional 401k, $5,000 goes in the account. If you contribute 5% to your Roth 401k, $5,000 goes into that account. All right, so that doesn't change. So that's number one. Number two, another thing that I notice many people aren't aware of is that if you contribute to your Roth 401k, the company match is always still traditional 401k. All right, so Roth 401k, your contributions are after tax. You won't have to worry about taxes in the future, but your company match is still going to be traditional 401k, so that's still going to be tax deferred, so you still will have some sort of tax liability in your retirement. All right, so that's two things that we noticed, which is why he sent me this article that kind of it's a good example that I'm going to review for you today. Hopefully it provides you value, and hopefully everyone, you're having a good day today. With dealing with this continued coronavirus chaos. All right, so like I said, I'm reading the article, How to Calculate Roth 401k Withholding from budgeting.thenest.com. So it says many employers now offer employees the option to contribute to Roth 401k as well as a traditional 401k. Again, reminder, Roth 401k is after tax, traditional 401k is pre-tax. Roth 401k plan contributions won't affect your income tax withholding, but the amount that you elect to contribute to the plan will affect your take-home pay. And we'll go through an example in a little bit. Knowing how much you will be withheld for your Roth 401k plan contributions helps you budget better because you know how much you will get to keep each pay period. Calculating Roth 401k withholding. To figure the amount that your employer will withhold to contribute to your Roth 401k account, you need to know your gross pay per pay period and the amount of your income you've designated to contribute to Roth 401k. So number one, first divide your annual salary by the number of pay periods per year to calculate your gross income per pay period. Second, multiply your gross income per pay period by the percentages you've elected to contribute to your Roth 401k plan to determine your 401k plan withholding. For example, say you are paid monthly, your annual salary is $72,000, and you elect to contribute 5% to your Roth 401k plan. Divide $72,000. Here, I'll show my screen just so you can follow along because I know I'm reading a lot. If you're on the podcast or listening via podcast, hopefully I'm able to explain this clear enough that it's valuable for you as well. All right, so now that I've shared my screen, I'll go back to the example. All right. Say you're paid monthly, your annual salary is $72,000, and you elect to contribute 5% to your Roth 401k plan. Divide $72,000 by 12 to find your monthly gross income is $6,000. Second, multiply $6,000 by 0.05, which is the equivalent of 5%, to find that your 401k withholding is $300 per month. All right, so to walk through an example, or to walk through that example, showing your take-home pay with taxes. If you live in Thief River Falls, Minnesota, and you make $72,000 per year and you're single, I'm using Thief River Falls because that's where I live. Depending on where you live, your outcome could be different. This is what your take-home income looks like. All right, so your marginal tax rate, your highest marginal tax rate federally is 22%, but your effective federal tax rate is 12.52. Your FICA tax is 7.65. Your state marginal tax rate is 6.8. Your effective tax rate is 5.1. And there is no local tax in Thief River Falls, Minnesota. So your total income taxes effective tax rate is about 25.28%. Therefore, during the year, you're going to pay about $18,204. So your income after taxes is $53,796. So your take-home pay is $53,796. So using the math that they said, if you are contributing $300 per month, all right, so 53,000, and you can hopefully do math, follow along with me here. 53,796 divided by 12 is $4,483. All right. So if you're contributing 300 of that to your Roth 401k, that leaves $4,183 left over for you to spend on a monthly basis. All right, so that kind of clarifies their example. But what we have to be aware of, because the third step of contributing to a Roth 401k is if you were previously contributing to a traditional 401k, it may affect your take-home income. All right, so your take-home pay when contributing to your Roth 401k is the $53,796 minus $300 per month contributed to your Roth 401k times 12 months is $3,600. All right, so 53,796 minus $3,600 means your take-home pay after contributing to your Roth 401k in their example is 50,000. Well, let's see if it'll draw. Let me draw my screen here. No, it won't let me draw. Okay, so your take-home pay is 50. Whoa, sorry, getting a little crazy with the technology here. Is $50,196. 53,796 minus $3,600. So if instead of contributing to your Roth 401k, you contributed that $3,600 to your traditional 401k, you're going to notice that your effective income tax rate goes from about 25% to about 24%, and your take-home pay goes to about $51,232. So here's where the discussion comes in. By contributing 5% to your traditional 401k, you're decreasing your effective tax rate by a little over 1% this year, and you're taking home about, get my calculator right back up, you're taking home about $1,000 more this year, all right, which as we know is less than $100 more per month. So that's where the advantage comes in that many CPAs and many of your tax advisors will give you, is that's why you should contribute your traditional. The problem with that is that you're still going to owe those taxes. You're just kicking the bucket down the road to your retirement, all right? And we have no control over what tax rates look like in the future. So that's a big question mark on how much taxes you're going to owe in the future. And I'm going to give you a much more analytical example of this in the coming days. But I just want you to consider that the difference of, is it more important to save money in taxes this year or save money in taxes in retirement when we have no control over tax rates, we have no idea what tax rates will look like, and we have a lot less flexibility of our income because we are now in retirement and we have what we have and that's it. Plus, keep in mind with all the stuff going on with coronavirus chaos right now, if they pump out $2 trillion in a bailout or stimulus package, they're going to need that money back in some way, shape, or form, likely potentially taxes, right? Can't predict the future, but it's possible, right? So going back to this example, all right, so employer matching contributions, your employer, or going back to the article I should have said, your employer may offer matching contributions for your 401k plan and is permitted, I guess I don't need to share my screen anymore. All right, so your employer may offer matching contributions for your 401k plan and is permitted to calculate the amount of the matching contributions based on the amount you contribute to your Roth 401k account. However, your employer is required to contribute that matching amount to a traditional 401k account and cannot simply add that money to your Roth 401k on top of your contributions. Like I talked about before, doesn't matter if your contributions are pre-tax or after-tax, traditional 401k, Roth 401k, the employer contributions will always be and are required to be tax-deferred traditional contributions. Tax effects of Roth 401k withholding. Unlike contributions to your traditional 401k plan, your Roth 401k plan won't have any impact on your income tax withholding for the year. This is because your Roth 401k plan contributions are made with after-tax dollars rather than pre-tax dollars. So you don't receive a reduction in your taxable income for your contributions. However, the money still grows tax-free while it remains in Roth 401k account. In addition, when you take qualified distributions from your Roth 401k plan in retirement, all of the money, including any earnings on the contributions, comes out tax-free. All right, this is extremely important, so I'm going to repeat it again and follow up with some points. However, the money still grows tax-free while it remains in the Roth 401k account. In addition, when you take qualified distributions from your Roth 401k plan in retirement, all of the money, including any earnings on your contributions, comes out tax-free. Why is this important? It's important because any money you put in tax-deferred accounts like your traditional 401k, which may save you money this year, creates taxable income in retirement, which as of today's tax laws will affect your Social Security taxes, which are double taxes because you pay taxes on the way in your Social Security. They can affect your Medicare costs, and it overall will affect your amount of retirement income you get to keep, right? So these are things to be important to be aware of, because the advantage of investing in after-tax type of accounts is they will not affect your Social Security taxes, they will not affect your Medicare costs, and you will have a more clear idea of what assets are truly yours and what income is truly yours to keep in retirement as of today's laws, according to my understanding. Please be aware, tax laws can change. The government has control over the laws. I do not. This is just my perspective on what my understanding is. But hopefully that clarification provides you value. Coming back to the article, maximum contribution. The Roth 401k contribution limits are cumulative with your traditional 401k contributions and cannot exceed $19,000 as of 2019. In other words, if you contribute, the max you can contribute to any 401k is $19,000, whether it's $10,000 to your traditional and $9,000 to your Roth, or $15,000 to your Roth and $4,000 to your traditional, you cannot exceed $19,000. If you're 50 or older, you can make an additional catch-up contribution of $6,000. For example, if you're 55 in 2019 and you contribute $10,000 to your traditional 401k, you can contribute more than $15,000 to your Roth. You cannot contribute more than $15,000 to your Roth 401k. All right, so overall, that's how Roth 401k contributions work. Keep in mind, I'm only comparing traditional versus Roth accounts today. I'm not including all of the other types of tools that are available to us. So conceptually speaking, the important points are, if you're considering just group retirement account contributions, traditional versus Roth accounts is what we talk about specifically today. But philosophically, if you're talking about just overall financial planning, pre-tax versus after-tax versus sometimes tax investments is really the name of the game, and it's extremely important to be aware and understanding how your assets are taxable or have tax liability when you want to use them in retirement. All right, so thank you again for taking the time to join me in my conversation today. Please let me know what you think by reaching out, commenting, liking, posting, or resharing my posts or podcasts. Thanks again for taking the time. Hopefully today's conversation brought you value, and I hope you have a great rest of your day. Thanks. Bye.